Welcome back, everyone, to The Deep Dive. This time, we're really rolling up our sleeves and getting into the 5 rules for successful stock investing.
By Pat Dorsey.
Exactly. He was the director of equity research at Morningstar, and he really knows his stuff. So
This deep dive.
yeah, it'll be like we have our own personal investing guru walking us through it.
Right. And what's so cool about Dorsey's approach is that he doesn't try to promise, instant riches or anything.
He's not about get-rich-quick schemes.
Oh, not at all.
Yeah.
It's more about building a solid strategy, one you can rely on for the long haul.
And that's what we're all about here, right? Making smart decisions for long-term growth, not just chasing fads.
Absolutely. So where do we even begin with that?
Well, Dorsey kicks things off with his first rule, which is do your homework.
It sounds simple enough, but
it's amazing how many people just kind of skip this step, you know?
Oh, totally. People get caught up in the hype. Maybe they hear a hot stock tip from a friend and they just jump in head first.
Right, without really understanding what they're getting into.
And Dorsey really drives this point home. Investing is not about blindly trusting someone else's opinion.
It's about forming your own informed judgment.
Exactly.
So what does that look like in practice? Is it more than just like checking a company's website or looking at their stock price?
Way more. Think of it this way. Imagine you're buying a house.
Okay.
You wouldn't just glance at a few photos online and sign the papers, right?
No way. I'd want to see it in person, get an inspection, check out the neighborhood.
Exactly. You want to know what you're getting into?
So for a stock, we're talking about really understanding the business, the industry, the competitive landscape, all of that.
All of it. Read those financial reports, yeah, but also get a feel for the management team.
Like their experience, their track record.
Their vision for the future. Yeah, it's about piecing together this whole puzzle.
So rule number 1 is basically becoming a detective, huh?
That's a great way to put it.
We're looking for clues to see if a company is truly worth investing in.
Absolutely. And that brings us to rule number 2, which might sound a bit, medieval.
Oh, here we go. Lay it on me.
Economic moats.
Economic moats, like with casters and drawbridges and
Alligators.
Okay, maybe not alligators, but you're right. It does sound a bit old school.
Well, Dorsey uses this analogy to explain how a company can protect its profits, just like a moat protects a castle.
Okay, so we're talking about competitive advantage here.
Right, those things that make a company stand out from the competition and, importantly, stay ahead.
So what are some examples of economic moats? Like, what actually creates that kind of advantage?
Well, a strong brand can be a huge moat.
Like, think Apple or Coke?
Exactly. Customers are loyal, and it's tough for competitors to replicate that kind of brand recognition.
So brand loyalty is like having a big keep-out sign for competitors.
Pretty much. Or you could have a unique technology or a patent, something that gives a company a real edge.
Like a pharmaceutical company with a breakthrough drug. They've got that exclusive right for a while.
Until the patent expires, yeah. It's like a temporary monopoly.
So it's like having a secret weapon that keeps the competition at bay.
Exactly. And then there are things like cost advantages.
Where a company can produce things more cheaply.
Right. Or network effects, where a platform becomes more valuable as more people use it.
The more the merrier.
Exactly. So economic moats are really about figuring out what makes a company uniquely resistant to competition.
It's not just about what they do, but how they do it better than anyone else.
And it's important to remember that some moats are stronger than others. Some might be pretty shallow, meaning that advantage could disappear.
While others are deep and wide and built to last.
Right. So we've done our homework. We found a company with a solid moat. What's next?
Well, that brings us to Dorsey's third rule. Have a margin of safety.
And this is all about being a smart shopper.
I like that. So how do we apply this to investing?
Imagine you're haggling for a car. You wouldn't just pay the sticker price, right?
You've got to negotiate, see if you can get a better deal.
Exactly. You're looking for some wiggle room just in case there are hidden problems or the car's not quite what you expected.
And that's kind of what a margin of safety is in investing.
You got it. It's about being a little bit conservative with your valuations.
So not getting swept up in the hype and paying more than a stock is actually worth.
Right. Buy a stock for less than you think it's truly worth. That way you're protected if things don't go exactly as planned.
So it's like building a buffer into your investment.
Exactly. And Dorsey provides some ways to calculate this. One simple method is looking at the difference between a company's stock price and what you think its true worth is.
The bigger the difference, the bigger your margin of safety.
Right. So it's not just about hoping for the best, it's about being prepared for the unexpected.
Okay, this is making a lot of sense. So it's rule number 4.
Rule number 4 is all about patience. Hold for the long haul.
The power of time.
Exactly. The longer you hold on to a good investment, the more time it has to grow.
It's like that snowball effect, right? It gets bigger and bigger as it rolls downhill.
That's compounding in action. Your returns generate more returns, and over time, that can lead to some serious growth.
And this is where frequent trading can really backfire, isn't it? You're constantly paying fees, you might get hit with taxes, and you could miss out on those long-term gains.
It's like trying to time the waves at the beach. You might catch a few good ones, but you're also likely to get wiped out.
Ouch. So Dorsey's saying time is our ally in investing.
Use it wisely. Find those solid companies with the wide moats we talked about and let them do their thing.
Don't try to outsmart the market by jumping in and out all the time.
Exactly. Focus on the long game. That's where the real magic happens.
Okay, on to the final rule. What's Dorsey's fifth piece of wisdom?
The fifth rule is know when to sell, and this can be the trickiest one.
I can imagine. It's hard to know when to let go, especially if a stock has been doing well.
Oh, for sure. But Dorsey gives us some good guidance here. He doesn't try to tell you exactly when to sell.
Instead, he provides a framework for making that decision.
Yeah, he gives you a set of questions to ask yourself.
So it's more about constantly reevaluating your investment, making sure it still aligns with your goals.
Exactly. Has the company's performance changed? Have those competitive advantages eroded? Is there something else out there that might be a better opportunity?
So it's not about setting and forgetting, it's about staying engaged.
But it's not about obsessively checking the stock price every 5 minutes either.
It's about monitoring the company's fundamentals, the things that truly matter in the long run.
Right. We're not trying to time the market. We're trying to make smart, informed decisions based on the facts.
This is great. We've now covered all 5 of Dorsey's golden rules. It feels like a really solid foundation for making investment decisions.
It is. But, Dorsey doesn't stop there. He also dives into some common mistakes investors make, things he calls the 7 deadly sins.
Oh, that sounds interesting. What kind of sins are we talking about here? Okay, so those 7 deadly sins you mentioned, those common investor mistakes, let's dive into those a bit.
Yeah, Dorsey calls them sins because, well, they can really hurt your portfolio if you let them.
Okay, so what's the first sin we should be on the lookout for?
The first one is swinging for the fences. It's that temptation to go all in on those risky, high-reward stocks.
Hoping to hit a home run with every swing.
Exactly. And while some risk can be okay, making that your main strategy as well.
It's like putting all your eggs in one very fragile basket.
Yeah, one bad bounce and you could lose everything. But actually, Dorsey's point is that investing is more like a marathon, not a sprint.
So slow and steady wins the race.
Exactly. Build a diversified portfolio, spread that risk across different companies, different industries.
Don't put all your faith in one hot stock tip.
Right. Focus on those solid companies, the ones with those strong moats we talked about. They're more likely to be around for the long haul.
Okay, I'm getting a better sense of why he calls these sins. Now, they're tempting, but they can lead you down the wrong path.
Totally. Okay, ready for another sin?
Hit me with it.
This one is believing it's different this time.
Oh, I've heard that one before. Usually right before things go south.
Right. It's that tendency to ignore history, to think that somehow the rules don't apply to us. This time it'll be different.
We've seen this play out so many times, though. The dot-com bubble, the housing crisis. People get caught up in the hype and forget that markets move in cycles.
Dorsey really stresses understanding market history. By learning from the past, we can be better prepared for the future.
So it's not about predicting the future perfectly, but about recognizing those patterns.
Exactly. Knowing that what goes up must come down and vice versa.
Okay, I'm really starting to see the value in learning from these sins. It's like Dorsey is giving us a warning about the pitfalls to avoid.
He's not trying to scare investors. He just wants them to be prepared and make smart choices.
Okay, can we squeeze in one more sin before we move on?
Sure. How about falling in love with products?
Oh, I think we've all been guilty of that one.
Right. We get so excited about a product, a new gadget, a cool service, that we forget to look at the business behind it.
We think this is going to be huge, but sometimes a great product doesn't equal a great investment.
Dorsey talks about Palm Pilot in the book. Remember those?
Vaguely. I was more of a Game Boy kid myself, but yeah, they were super popular for a while. What happened?
They had a fantastic product, but ultimately they struggled.
Why is that?
Competition was fierce, profit margins were thin, and they just couldn't keep up.
So the lesson here is, don't let your love for a product blind you to the realities of the business.
Exactly. You got to look beyond the shiny exterior, dig into those financials, understand the competitive landscape, the management team.
Does the company have what it takes to succeed in the long run? That's the real question.
Right. Okay, so we've covered the 5 rules. We've talked about a few of the 7 deadly sins.
What else does Dorsey have up his sleeve?
Mm-hmm.
What other investing wisdom can he share?
Well, once you've got those basics down, Dorsey takes you deeper into the nuts and bolts of analyzing a company.
Oh, like what?
He talks about things like valuation, cash flow, the quality of the management team.
Okay, let's start with valuation. How do we even begin to figure out if a stock is worth buying?
This is where Dorsey really dismantles that whole greater fool theory.
Which is what exactly?
The idea that it doesn't matter what you pay for a stock as long as you can find some bigger fool to buy it from you at a higher price later.
That sounds kind of risky, like a game of financial hot potato.
It is. Dorsey's all about buying stocks below their intrinsic value.
Intrinsic value meaning?
What the company is actually worth based on its assets, its earnings potential, all of that good stuff.
So it's not just about what the market is saying a stock is worth at this very moment, but what it's truly worth in the long run.
You got it. And there are ways to calculate this, even if you're not a financial whiz.
Dorsey lays it all out in the book.
He does. It takes some effort, but it's worth it to find those hidden gems, those companies the market might be undervaluing.
Okay, I'm liking this approach. What about cash flow? Why is that so important?
Well, earnings can be manipulated, Companies can use accounting tricks to make things look better than they are.
But cash flow is harder to fudge.
Much harder. It's a more accurate picture of a company's financial health.
So it's about looking beyond those flashy earnings numbers and seeing how much cash is actually coming in and going out.
Exactly. One important metric is free cash flow. It tells you how much cash a company has left over after covering its expenses and investments.
Okay, so it's like checking the company's bank account to see if they're actually making money, not just playing accounting games.
Exactly. And a healthy cash flow means a company has more flexibility. They can pay dividends, buy back stock, make strategic acquisitions.
That makes sense. It's a sign of financial strength and stability.
Right. All right. Last but not least, let's talk about the management team.
Yeah, the people running the show. That's got to be important.
Hugely important. Even a company with a wide moat can struggle if the management team is making bad decisions or, even worse, acting unethically.
So how do we evaluate the management team? It's not like we can just ask their friends for references.
That's where Dorsey's insights are so helpful. He gives us some red flags to watch out for.
Okay, like what?
Are they paying themselves excessively? Are they transparent with shareholders? Do they have a clear long-term vision?
So it's about looking past the PR and the marketing and seeing how they actually behave.
Exactly. Dorsey even suggests paying attention to how they communicate.
Really?
Yeah. Are they clear and concise? Do they address problems head on? Do they seem passionate about the business?
It's like we're detectives again, looking for clues about their character and their competence.
Exactly. We want leaders who are good stewards of shareholder capital, who make decisions that benefit the company and its investors in the long run.
This is great stuff. Dorsey's 5 rules, the 7 deadly sins. Now this deep dive into company analysis.
It's a lot to take in, but it's all about empowering you to become a smarter, more informed investor.
Okay, before we wrap up, I have one more question for you. So it's like having this whole new toolkit for evaluating companies and making investment decisions.
Right, and the beauty of it is it's not about following someone else's picks blindly.
It's about learning to think for yourself.
Exactly. It's about taking control of your financial future.
Empowering yourself to make smart choices.
And, as you start applying these principles, you might be surprised by what you notice.
Like what?
You might start seeing those economic moats everywhere.
Or maybe you'll start questioning companies you used to think were invincible.
It's all about shifting your perspective, thinking critically.
So now that we've, kind of opened up this world of investing with Dorsey's help, what's next? What can our listeners do to actually put this knowledge into action?
Well, first off, don't be intimidated.
Investing can seem really complicated.
It can. But Dorsey breaks it down into manageable steps. Start with a company you're genuinely curious about.
Like one whose products you use or a brand you admire.
Yeah, something that sparks your interest. Then put on your detective hat and start digging.
Time to do our homework.
Exactly. Read those reports, explore their website, see what the analysts are saying.
And look for that economic moat.
Yes. Figure out what sets them apart, how strong is that competitive advantage.
Remember, some moats are wider and deeper than others.
Right. Once you understand the business, then you can move on to valuation. Does the stock price make sense?
Is there a margin of safety built in?
We're not looking for get-rich-quick schemes, remember?
We're in it for the long haul.
Exactly. And don't forget those 7 deadly sins.
Oh yeah, those tempting traps.
Stay patient, stay disciplined, and keep learning.
Investing is a journey, not a sprint, right?
It is, with its ups and downs, its twists and turns.
But with Dorsey's guidance, we've got a pretty good map to follow.
We do. So to our listeners, keep exploring, keep asking questions, and keep diving deep.
Because the more you learn, the more confident you'll become.
And the better decisions you'll make.
Well said. That's it for this deep dive into The 5 Rules for Successful Stock Investing by Pat Dorsey.
We hope you found it helpful.
And that you're feeling inspired to take control of your financial future.
Happy investing, everyone!